All right, folks, welcome to Investing for Beginners podcast. Today, we're going to talk about American Express. We have our good friend Brett Schafer back from Chit Chat Stocks to talk to us about American Express. This is a company that Andrew and I both own. Unfortunately, Brett does not currently own it, but it is high on his watch list, and I know it's one of his favorites. So this should be a fun convo. So, Brett, welcome back to the show, and let's talk AMEX.
I know it's unfortunate. I haven't owned this in the last year. It has done quite well, but as someone who maybe is too disciplined as an investor, it's going to remain on the watch list for the time being. And I guess I'm greedy and waiting for a better price to pay, which I should say Andrew and Dave got a couple of years ago. It's an amazing business. Buffett owns 20% of it, give or take, over at Berkshire Hathaway, and they've owned it for a long time. And I think given the recovery as we're recording this in early to mid-May, it may be a 100-bagger for Berkshire Hathaway. If it isn't, it's damn near close. I know I've written an article about them at the time and or when that happened. And I'm excited to get into it, talk about this company, why it's so profitable, why it's done so well for shareholders, and what gives them their magic in the credit card industry.
Mm-hmm. Yeah, yeah, me too. So, fun fact: a lot of people are familiar with Buffett buying buying American Express, but I didn't know this. But during the salad crisis back in the '60s, when he first took a bite of American Express, he actually didn't hold it that long and sold it. And then later in the 90s is when he took the big bite that he now currently owns the company. So he's owned it for a long time. But I mistakenly thought early on when I was learning about his investment in American Express, I kept coming across why is this not the longest owned company he owns? And then I finally discovered, I had to dig a lot actually to figure it out, but I finally discovered that he had sold it not too long after he originally bought it for a nice tidy profit, by the way, and then came back to the Apple again later on. So I thought that was kind of interesting.
Yeah, and then at the time, their business model was entirely different,
Mm-hmm.
and they've been one of these long-standing American brands. It's literally the name as a
Yeah.
company that I think is 150 years old at this
Yeah.
point, over 100 years
Mm-hmm.
for sure. They've been able to evolve with the times and just be a player in the financial space for decades and decades and decades.
Yeah. 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 They started as a Pony Express kind of business competing with Wells Fargo back in the 1860s, I believe. And so, they've come a long ways, baby. That's for sure.
Yep. They didn't have the platinum cards back then.
No, they did not. All right, so let's talk about the business a little bit. So, what exactly does American Express do?
Okay, so they are both a credit card issuer and a payments network. So at the same time, they operate a payments network similar to a Visa or a MasterCard. But unlike a Visa or MasterCard credit card, where you have a Visa card, it might be from Bank of America. So it's issued by Bank of America, but it runs on the Visa payment rails and they distribute the revenue through that, or they split up the revenue of all the transactions, and then the bank is doing the credit lending. American Express does both. So you have an American Express card, which uses the American Express payments processing. You have that 2% fee, use it for your transaction at a merchant or wherever. And they are also the ones that are your bank with the credit card. They're the ones that are making you the credit card loan. So I call it, and I think it's a pretty apt term, the vertically integrated credit card issuer, and that's how they make their money. So we can maybe split up. I'm just using the last quarter figures here. They generated about $17 billion in revenue net of their interest expense last quarter, and about half of that, I think slightly over half, was from what they call discount revenue, which is just the credit card swipe fees. So that's the same amount of money that's the same type of revenue that a Visa or MasterCard are making, but unlike Visa or MasterCard, which are just taking a tiny percentage of each transaction and then passing a lot along to the other payment processors or the Bank of America itself, who's the credit card issuer, they're taking the full or a lot more of that 2 to 3% of that swipe fee. So that was 8.7 billion of the $17 billion in revenue they had last quarter. And then on top of that, the second biggest driver of revenue will be their net interest income on credit card loans. If we scroll through, let me try to find the total amount of credit card receivables they have. Yeah, about 200, a little over $200 billion in worldwide total loans and card member receivables last quarter. That generated about $4 billion in net interest income. So that's right about 25% of the revenue. So again, that's first, we have over half coming from the swipe fees. That's the, payment revenue. That's what's going to grow as more people are spending more money on the American Express network. And then the net interest income is going to be the credit card loans, and that's combined together, the business model that is usually separate when someone's on Visa or MasterCard. And then the third largest one would be their net card fees. Now, these, unlike, and there's some players out there, Chase has their, I think it's called Sapphire Preferred. There's some other premium ones, including Capital One. But American Express is known for their high fee and high reward credit cards, and they're tailored to the travel, entertainment, and food space. They have partnerships with Delta Airlines, Hilton, and Marriott, which are long-standing partnerships where they're actually issuing cards for these businesses, and they tie together, very, very well, where American Express will give their high fee card members, benefits at Hilton, Marriott, and stuff like that. And specifically, if you use the cards issued by American Express, but as the Hilton credit card or the Marriott credit card or the Delta credit card. Now, these fees were, let's see, it's about 2.3 billion in revenue of the 17 billion in revenue last quarter. So not a giant percentage of the overall business, but a good chunk. And it is one of the, I'd say, key facets of the entire business where they charge these fees, but they offer very strong benefits for people that either travel a lot, want to use their restaurant bonuses, stuff like that. If I look at the Platinum card, which is their expensive one with $700 annual fee, you get a $200 hotel credit, a $240 digital entertainment credit, $200 airline fee credit, $200 in Uber Cash each month, plus other offers. You can get things like, 5 times back on flights, 5 times back on prepaid hotels, $200 clear credit and TSA pre-check credit, and I'll probably close out with this. With these cards, they have these airport lounge networks that they've built out over the years, and it's something that you would think is highly replicable. Another credit card company can do that, but it's very difficult, to get space in an airport. It's a highly regulated area, and you have to do a good job with these. So these type of things are what they can offer, and gives them almost a competitive advantage with the scale, the relationships with Marriott and Hilton and Delta, and then all the players within travel and entertainment, and then within these airport lounges. That's kind of what gives them a very strong customer value proposition. And it's how they've become, I would say, the definitive leader within travel, entertainment, and credit cards, just for, I say, a richer portion of the population in general.
It's a great explanation, by the way. When I think of American Express, I always think of, higher wealth individuals, the high rollers, people that have money, have an American Express card, and they have it for a reason because of all those perks that you were mentioning. It's not just the exclusionary or exclusiveness of having the card. It's because it gives them the best options to use for the things that they want to do. Because when those individuals travel, they want those perks. They want the airport lounge. They want to sit in first class. They want to get upgrades on their flights or their meals or movies or any of those kinds of things. That's what they want, and that's what they're willing to pay for. And American Express gives them all those advantages. I always think of American Express as like a two-part business. Like you have the bank, and then you have the network, and it's different than Visa, like you said, because their network is a closed loop, and so it only works for American Express cards, which, like you said, gives them the advantage of having those fees. And somebody who worked in the restaurant business for a long time, I in part loved American Express cards because it generally meant that the customer was going to spend more money,
Yeah. What I would add on that to the advantage of having both sides of the business is I mentioned over 50% of the
Mhm.
revenue comes from that high margin swipe fees that they have from getting, well, in the United States, they have, what is it, the 100% acceptance. They're pretty much at parity with them. So they have that, and all those profits they can take to drive, membership bonus rewards for signing on for new cards. They can add even better perks that outlast their credit card fees, and they can add all these other perks for their members as opposed to another credit card issuer that doesn't, that's operating on Visa or MasterCard's rails. You don't have that profit pool. And I think if we look at the amount they spend on marketing every year, I don't know if they have that in their quarterly report where, okay, well, when we look at, yeah, I have it here. So they spent $1.5 billion on marketing in Q1 of this year. They spent $4 billion, over $4 billion on card member rewards, which is much higher than their net card fees. And they spent $1.3 billion on card member services. So they have all these profits from the swipe fees that they can take to provide a higher customer value proposition to these, with and spend more on marketing while still remaining profitable. And that's something that
No,
no
no, for sure,
competitor can
for
do.
sure. The other thing that I wanted to mention too is that the the stereotype around the company is because it's been around since the 1860s or so, is that it's an air quote older fuddy-duddy kind of company. And at least that was my take on it when I started researching the business. But they are actually expanding their customer base via younger clientele, and which bodes really, really well for the business going forward.
I agree. And you could have said that that
Mm-hmm.
narrative still matched up with the underlying data, maybe
Mm-hmm.
even right before the pandemic. And you couldn't see it, kind of the pandemic mixed up some stuff, and you couldn't see the numbers for a little bit, but they had new management come in. These were people that were, nice thing about their culture is they had people that worked there for a long time, but they understood that they weren't catering to millennials and Gen Z well enough to acquire these customers that maybe aren't spending as much as boomers at the time, but should grow into their spending, especially these young, rich technology and finance people in the United States. So they did things to work better with what millennial and Gen Zs like more. For example, Uber Cash. They have a giant partnership with Uber, and then they also acquired these restaurant platforms like called Resi. If we look at their other big fee card called the Gold Card, $325 annual fee. You get like things 4 times back at restaurants and these 4 times point things, and you get dining credits, Uber Cash credits, and Resi credits, which is it's like a reservation platform for restaurants. You get $100, yeah, each calendar year. So those have helped, and I don't know have the exact number in front of me, but I think it's over 50% of the new cards they're acquiring, each quarter now are coming from Millennial and Gen Z. And we've seen an inflection in the growth of their card members starting coming out of the pandemic added these, once they basically modernized their service and started catering to the full population of the United States and people around the world. Where, let's see, in 2012, for example, I have the KPIs up here from FinChat. 2012, they had 102 million cards. In 2020, they had 112 million cards. Now, some of that was from losing the Costco partnership, which, hurt them a bit. But if we go from 2020 to the last 12 months, they've grown from 112 million cards to 147.5 million. So they've seen consistent growth, and it's mainly coming from these millennial and Gen Z customers, which hopefully should have very high lifetime values if they're going to be with American Express for 10, 20, or 30 years in the
Yeah,
future.
great, great, great points. So, if you had to define the moat for American Express, what would you say it is?
So they have two, and I think the first and most important is the network effect. So again, I guess maybe we'll step back for beginners. A network effect is when you add more, say, more members, more customers, more users of the platform, the more valuable it gets. And they're a bit of a marketplace where you have two sides of the network. You have merchants, which need to accept American Express, and then you have the customers, which need to have the cards. Now, you can't really start one of these payment networks from scratch. It's very, very difficult, especially nowadays where there's other ways to pay. You have the wallets, the phones, the Apple Pay, which I should say isn't necessarily competitive to them because you're usually using one of your cards within Apple Pay. But it'd be very hard to say, look, you accept Discover, American Express, Visa, and MasterCard. Why don't you add a fifth one? And you don't really need to. But American Express has the firepower and it has the established base where you have hundreds of millions of merchants accepting your cards, and you have, as of last quarter, I already mentioned 147.5 million cards in circulation. And that's very hard to compete with as someone starting from scratch. Now, 10 years ago, they had, again, we talked about their, let's say, not
Transformation.
reformation, but kind of, they took a next step. Yeah, their transformation into making themselves more modern is they had fallen behind significantly, even in the United States, their home market, to Visa and MasterCard when it came to acceptance. I think they were around 80% acceptance. And that can be a problem because then one out of every five places you go, you don't know if that card's going to be accepted. And if you're with a group, it can be embarrassing. If you're like, oh, does this card work? You don't want to, it's just kind of a thing for socially. People don't want to have that. They worked very, very hard to get to essentially 100% acceptance and on par with MasterCard and Visa in the United States. And that has helped them significantly, I would say, because now people don't ask, oh, do you accept American Express? It's pretty much established that at most places, especially their core travel and entertainment and food, it's going to be fine and no one's going to, everyone's going to take your card. Now, on the other side of things, I would say from a network effect, the more cards they get in circulation, the more power both the users of the American Express cards and American Express has over these merchants. It just grows and grows and grows. Visa and MasterCard clearly have more because they have, I think, billions each of cards in circulation, as opposed to American Express at 147.5 million. But the larger American Express gets, the more these cards need to be accepted. And now today, their plan is over the next decade, and probably it will take a little bit longer, is to try to get in as many of the wealthier markets around the world, as many of the larger cities. So, for example, something like a Tokyo, Singapore, Hong Kong, London, other places like that. They want to get and replicate the model they did in the United States in some of these foreign markets, which will help them because they're not nearly on par with Visa or MasterCard globally. That's kind of the next step for them to try to, grow. And then the second competitive advantage, which I'm sure you can talk about as well, is that brand. They've been around for a long time. They have that allure of the special black card that they offer people that are ultra wealthy, and they also have just a solid brand, I guess. It's kind of hard to quantify, but I would say within the credit card space, they're known for being a high quality brand. People like it. It, I guess,
Mhm.
exudes some status,
Yeah.
and that helps them with compete
Yeah.
with someone like Capital One, for example.
Yeah, for sure. It feels like after working in the retail business, i.e., through restaurants, it's always felt like people always confused Visa, MasterCard, and American Express as kind of all the same thing. And to be honest, when I was working in the industry, I thought they were. It wasn't until I got into finance that I realized, no, they're actually kind of distinctly different. They do compete to a certain extent, but they are different. But American Express always has had that cachet and that status that people would aspire to, whereas Visa and MasterCard felt like more of an everyday kind of thing, where American Express feels a little more cachet. And it's a product that I've been using since I was a young kid. When I would travel with my friends, we would go to Europe, for example. We would buy American Express traveler's checks. This was before credit cards were a big thing. They were obviously around then, not old, but they were around. But as an 18-year-old kid, I'm not going to Paris with an Amex card. I'm going with traveler's checks. And that's how we would travel, because you got a good exchange rate on the money, and it was a safe way to carry money with you as opposed to carrying cash, and well, at least in theory. And so I've been using their products for many, many years and have always had good experiences with them. One of my friends lost some of his cashier's checks when we were in Europe, and because he had the receipts, we were able to go to a American Express store and get those redeemed, and it was actually kind of a seamless experience considering where we were. We thought we were pretty terrified that we were going to be in a lot of trouble, but it worked out nicely. So the after working in the business industry and dealing with American Express cards, they certainly have a very strong brand, and when somebody puts that down at a table in a restaurant, it exudes a level of affluence that a Capital One card does not. And I'm not trying to disparage people that have one or the other, but it exudes a different kind of brand level of quality as a wealth. And that always kind of shone through with the company. And one of the reasons why I was attracted to it when I was looking as.
Yeah, and some listeners out there that might be people like ourselves that are
Mhm.
frugal or value investor type and go, well, we don't care about the cachet
Right,
of
right.
premium luxury type product. But I would argue that you care about
Mhm.
saving money. So the perks they're able to offer that are superior to other credit card companies can be
Mhm.
worthwhile. So they can serve both sides of the market while giving tons of perks for things you want versus having that
Mhm.
premium brand that a good percentage of the population.
I work really hard to find the best insights I can every single month at Value Spotlight. To see a sample of my previous work, go to stockwriteup.com.
Yeah.
Seeks.
Yeah, absolutely. I worked with a gentleman that he and his wife would take cruises every 2 years, and they had a routine. But what they did was they used their American Express card to buy everything for the year, and then they would pay it all off during the course of the year, and they would earn gazillions of points, and then they would use those points to pay for the plane tickets as well as the cruise that they would go on. And they would get all kinds of other perks because they were using their Amex card to make all these purchases. And when they would go on a cruise, they could upgrade into nicer rooms and get better excursions and things like that. So it always worked out really, really well for them. And it was a system that he and his wife had figured out a dozen years ago, and it had been working it for they had gone on 6 or 7 trips by the time I met him. And I just thought that was a brilliant idea, and it just kind of shows the power of the brand and why he would never consider leaving American Express to go to another card.
Yeah, that's why they have in I think their commercials, their tagline is the
Yeah.
power of American Express. And that comes back connecting it to an investing and competitive advantage standpoint. Those perks they're the only company that can offer so many perks to customers. I think I have it up here again. Yeah, last quarter. So this is only in 3 months. They offered $4.4 billion of card member rewards to their members. So that's a
Hmm.
huge amount. And the only reason they're able to do that is because they have the vertical integration with the payments network where that just prints money for them.
Yeah, exactly. And it's you were talking about kind of the differences between some of the marketing that they're spending. You could easily argue that amount that they're spending on the rewards is way more valuable than any sort of print or video marketing that they're doing, because it just reinforces the use of the card. And the more that people can use those rewards and benefits, the more likely they're going to continue to use the card to get more rewards and benefits. So it creates this nice flywheel.
Hmm.
I know that term
Yeah,
gets
yeah,
used
exactly.
overused a lot, but it's in this case it's appropriate.
Yeah, flywheel or
Yeah,
ecosystem.
right.
In
Let's
this
stay away from
case,
the ecosystem. That's a little too.
either way, it's a good business and it's a win-win for everyone, even the merchants that, as you mentioned, people kind of go, these are higher fees. But if you, let's say, Dave, if you could populate an entire restaurant, it's not a McDonald's, it's a one that people can spend a lot of money on.
Mhm.
If you could populate an entire restaurant with American Express cardholders, you'd probably choose so because they're going to
Yep.
be big spenders.
Yes.
Um,
Yes.
and then I'd mention
My
one on the
servers would be very happy.
yeah, yeah, exactly. Good tips, good stuff like that. The one thing I'll mention, I don't know if they're that as good as some of the perhaps European luxury brands at doing this, like a Rolex, a Ferrari, or some of those other ones. Their advertising is trying to stick within quote unquote. I know some people, it's not, if you roll your eyes at this, it's not for you. They try to stick in stuff that's high, quote unquote higher class.
Yes.
So they're not sponsoring NASCAR, at least I don't think. Hopefully, I'm not wrong there. But they sponsor the U.S. Open tennis tournament in New York every year, where you have tons of high spending members go. They sponsor a golf tournament,
The
stuff
Masters.
like that.
Something like that.
Yeah.
Yeah.
Yep, exactly. So they're trying to stick and create, again, you mentioned that flywheel, the marketing towards the clients they want. And we're not really talking about the business side of things today, but they also essentially offer this to small business owners. So you can get these travel cards if you're a smaller, medium-sized business or even a larger one, and you can earn all this stuff and all these perks within your business. And again, they're still making a ton of money because you are spending within their network.
Yeah. Yep, exactly. That was one of the fears during the pandemic was the travel was going to go, the lack of travel was going to kill American Express because the business travelers were not going to be flying to their meetings and not using their AMEX card, whether it was personal or whether it was business related. They were not going to be using their cards, and so that was a big fear about how was it going to rebound from that. And they did quite nicely, thank you. But that was one of the things that people were certainly, legitimately concerned about, and it was certainly understandable. And truthfully, that was one of the things that attracted to me to the company, was because when I would listen to earnings calls during that period, the CEO, I'm going to blank on his name, he was very calm, cool, collected, understood everything that was going on, and was not he wasn't panicking, he wasn't overreacting to what was going on, and just kind of stayed the course and believed that when things came back, that it would go back to normal. And he was proven right. And that to me was like, okay, this guy knows what he's doing. He's got a good finger on the pulse.
Yep, exactly.
Exactly. So, all right. So what, I think we're both fairly bullish on the company, but no company is perfect. So what are some potential risks or downsides to investing in a company like American Express?
One downside is that they are a lender. So if there is a big consumer contraction in just loan performance, which means for any beginner, just less people are paying off their loans. And each quarter there is, a percentage of people that don't pay off their loans. It's not like any company is going to be perfect in this regard, and American Express isn't either. But if you see rising loss rates, rising delinquency rates, their earnings are going to go down. And they've been so far, when I know it's the last couple of years, there's been some very strange developments within consumer lending and consumer spending. It's kind of been uncertain, the inflation. Some people are spending more, some people are spending less, some loans are performing better. It's not all kind of performing in sync like in other business cycles. But American Express has done much better than, for example, a competitor like Discover, which goes for very cheap credit cards. Their 30-day past due is still 1.3%. That's been very steady, and their net write-off rates have been right around 2%, which is just the percentage of their total card member loans and receivables that they write off and say, all right, this person's not going to pay back. Now, if that rises to 4% in a recession, well, that could lead to some deteriorating earnings for a short while there. And I am pretty confident that they'll be able to get through the cycle better than most banks, most lenders, most credit card issuers, because they cater to that higher clientele. But you can see a major earnings hit if you see rising loss rates at the same time when card spending goes down. Because during a recession, I'm sure there would be either a slowing of growth or a decline in discount revenue for at least a temporary period. So I say that would be the number one concern. People also talk about Visa and MasterCard, and I would have said 10 years ago that that was a major concern because they weren't at even product parity, or excuse me, acceptance parity with Visa and MasterCard in the United States. But I would say now that that competition is it's not going away, but I'd say they've managed that much better now, and they, given their vertical integration, may be able to play offense and have a competitive advantage versus Visa and MasterCard, and maybe gain some market share and spending. But that's perhaps part of the bull case over the next 10 years. And besides that, I think it's a rock solid company. Other things I worry about as someone who follows them and has them on the watch list is things like deteriorating experiences and reviews at their airport lounges, that and other things within the, that they offer members, and that can perhaps turn off some long-term customers, get them to switch to, Chase Sapphire Preferred or Capital One, which also offer these lounge access. But that's a small one, and I think they'll be able to manage just fine.
Yeah.
So we'll see. But it's a bit of an issue where the bigger you get, there's only a limited amount of size at these lounges or whatever else they're offering. And you can't have everyone on American Express, or else it doesn't have that differentiation between, oh, we have American Express, we're better than you type deal. That, yeah, is a bit of a balance, but just something that I'm watching out for as someone that follows the stock.
Yeah. Those are all legitimate potential risks to a company like American Express. Something that doesn't keep me up at night, but is certainly something I think about, is potential competition from other card networks. Square, when they first started out, went gangbusters, and they were trying to develop a closed loop network similar to what American Express has created. So far, I would say that threat of competition is probably not going to come to pass. Something that I am going to keep my eye on is what's going to happen with Capital One and the whole Discover merger, and how. My first take is that it could be potential competition, but I also feel like maybe they're going after a different customer, and so it may not necessarily be direct competition. It could be where they fight on the edges, as opposed to we're coming for you kind of thing. But that could also change too. Maybe once they have their own network, once Capital One acquires Discover and has their own network similar to what American Express does, maybe they up their game and try to go after American Express. But I haven't read or heard anything that's in the works, but it's certainly something I'm going to keep my eye on.
Yeah, you have the, I guess, developing competition there, and we'll see what Capital One decides to do and what market they target. And you are right, they target a different subsegment of the population. But I would say it's almost bullish for American Express, because it shows that Capital One wants to spend all this money merging with Discover, because they essentially want to copy American Express's vertically integrated model and get that advantage, which American Express has built up over 3 decades. And I would say the fact that it's one brand, they built it mainly internally, you're going to have combine Capital One and Discover. People aren't, are you having a Capital One card and you pay with Discover, or is it all going to be renamed to the Capital One network? That's something with branding that's going to take a long while to do, and I'd still say American Express has a wide competitive advantage even over this newly combined competitor.
Yeah, I totally agree. Now, one thing that's been on the radar a little bit is that Visa and MasterCard have certainly been in the crosshairs of other countries' regulations through the years, but for whatever reason, and I haven't heard it or seen it, or I haven't been able to figure out why, American Express doesn't seem to fall into those crosshairs. Like, I remember specifically a few years ago, Australia was coming hard after Visa and MasterCard about transaction fees that were being charged, even though everybody in the industry knows that's that they're a peanut, they're peanuts compared to what JP Morgan's charging actually. But anyway,
right.
But why American Express wasn't included in that, I've not been able to quite determine.
Yeah, maybe they're good lobbyists.
Yeah, maybe better lobbyers than the other guys.
I I think they're just not big players in a lot of international markets. There are a
Mm,
few countries like Mexico and Japan that they have decent market share, but I
mm,
just don't think they're large enough. For example, when I'm traveling, I would definitely not only take an American Express
mm,
card. I'd make sure to have a Visa or a MasterCard within my wallet if
mm.
that's how I'm paying for things, because in a lot of these countries, it's not ubiquitous acceptance.
Right.
So maybe that's what it is. Maybe they're just not large enough,
Mm,
but they're hopefully going to be
mm.
over the next 10 to 20 years, and that's
Right.
one of their big, and that's one of the things I'm following. They don't disclose it every quarter. I think they talk about it a lot at their investor days that they do every couple of years, but the amount of, terminals that are accepted for American Express outside the United States, how fast that is growing is just a very important thing for them to expand the American Express card base outside the United States.
Yeah. Yep. Yep. I totally agree. Totally agree. Good points. So it's kind of obvious to me from not only today, but other things that you've written and talked about on Chit Chat Stocks is that you kind of like the business. So why the heck don't you own it?
Well, I think it's a little expensive for not a super fast growing lending operation. It trades at, let me just pull up the PE here. I think the PE might be a bit inflated, so I might want to look at forward here. Just or sorry, not inflated. They had some inflated earnings from a one-time sale.
Mm,
They're trading at a PE of 21, which you might think is not that cheap if you look at Magnificent Seven all day, but I would say that's a somewhat premium valuation for a company like this. If we look at the forward PE estimates, we have 19 and a half. So not extremely expensive, but not extremely cheap either.
mm,
I think through the market cycle, they will be able to grow their earnings per share by a double digit rate. I think investors will do fine buying, and right now we're recording as it's recovered a huge amount, over $300 a share. I It's just one where I want to buy when everyone hates it or people think a credit crunch is coming.
mm.
And even if a credit crunch comes, they have the balance sheet to get through to the other side and the client base. And I think the diversified revenue streams get through to the other side of a lending crunch. And I'd rather buy then when things look ugly as opposed to buying today, which I think I didn't know about I didn't follow the stock in 2020. I think 2020 would have been that time period. In late 2023, in an old investment fund I ran that shut down, we were buying in late 2023. So that was another time where I thought it was very cheap, where people were very, I'd say, I don't know why they were pessimistic at the time. Maybe I think it had to do with the inflation and people worried
Yeah.
about consumer lending getting worse, which didn't really happen,
Mm,
especially for the high end side there. So I guess I'm waiting for that to happen again. I know that the stock will probably do fine over the long haul from here, but when Buffett bought it in 1991, and maybe he added to it at a later time period, it was at periods of distress for the industry. But given American Express's competitive advantage, they were able to gain market share and come out clean on the other side with a healthy balance sheet.
yeah. Yeah. I mean, and that's why he bought the company because he knew they had a competitive advantage and he took advantage of what he felt like was a mispricing in the market. And I'm not criticizing you for waiting. I just curious. I've always been curious, because if you listen to what you've talked about on Chit Chat Stocks and read some of the stuff, it's quite obvious you're very bullish on the business. And
Yeah,
I
I
was
do think.
curious why you
Or,
hadn't taken a bite of the apple yet.
yeah, I guess I have. It's just forward returns. I maybe how I look at it is I think they can grow earnings per share at a double digit rate, on average, depending I guess on inflation, because inflation can help them. So if inflation is very very low, maybe they won't grow that fast. But at a PE today of 20, if their multiple contracts back to 13 to 15, then the next 5 years might not be great for returns, even though earnings per share grow at a fast rate. And I'd rather be in a position where I can buy at 13 to 15 times earnings as opposed to 20 for a stock like this. So, yeah, just greedy, I guess.
Yeah.
Waiting for the fat pitch.
Right. Yeah, and there's nothing wrong with that. And I think to your point, the fact that it is trading at a higher multiple right now, a lot of people are listening and thinking, well, 2021 PE is not high. And you think about, like you said, the Mag 7 or anything Visa, MasterCard are in the 30s to 40s, but
Yeah.
they're not. So American Express is kind of a different beast in that I look at it as a bank, and banks trading at a PE of 2021 are kind of on the high side. And if you look at any of the larger banks, they're going to trade generally lower than that. And I think you kind of have to lump them in there with that. So if you're looking at a relative return, you have to think about it in comparison to other. You can't compare it to Visa and MasterCard because it's not the same kind of business. But I compare it to a bank, JP Morgan or something along those lines, and what kind of return will I get on a 13 or 14 PE versus a 20?
Yep, I agree.
So that hopefully that's helpful. So as we're wrapping up, what are your thoughts on how people should approach maybe looking at a company like American Express, and maybe how they could approach this as opposed to Nvidia or something?
Okay, yeah. Well, I can maybe say what I'm watching when I look at their
Mm.
quarterly results.
Yep.
I'm looking at, I guess, their spending volume growth. That's one of the things they highlight right away. That's always something that someone's going to be looking at. I'm looking at their write-off rates. Hopefully, they're staying pretty steady with their, strong clientele with very, very high FICO scores in general. And I'll be looking at net cards in force growth, which is just essentially how many cards they added in the quarter, because I kind of look at that as, all right, we spent all this marketing money to acquire these customers, and hopefully they are going to stay around with us for 10 to 20 years. So if they add, as they did last quarter, I think over 3 million new cards again, if they keep adding that, that is hopefully adding, to the intrinsic value of this business. So that's a key KPI I'm watching. In the near term, I'm going to be watching for the potential upgrade for the most important card they have, which is the Platinum card. At least I think that is the most important card. That should be coming this year, given how they usually the timeline of upgrades. So I'm going to be interested to see what the fee is on that and how people respond to it, because that is, as they do these refreshes and change, what the fee is and what customers get offered, that is it's one of the biggest risks the company has, because they need to get that right each time, especially for their flagship cards. So I'll be watching that. And then as I look at the stock, I would, I don't know if I'd recommend this, but the way I look at it is this is a rock solid business, has a good balance sheet, serves a durable clientele, has multiple competitive advantage. I want to buy this when everyone hates stocks in general. And that's how I'm looking at it. And when buying it, I think it can be one of those that's a permanent blue chip holding in your portfolio, because even though they're a large company, even though they're a slow grower, they can, given their business model, they have permanent purchasing power protection versus inflation. So it's one I think can be a never sell position in your portfolio. It's not something you're too worried about unless, especially because their earnings ratios never get too extreme. I don't think it's something you have to worry about of, oh, okay, this mature large cap I own just now trading at 40 or 50 times earnings. What do I do? I think returns are going to be bad. It feels like things are getting out of hand here. It's one I think you can never sell, and that's why Buffett at Berkshire Hathaway turned it
Has
into
it?
a 100-bagger. Yeah, and he
Has it?
hasn't sold, and he hasn't sold a share. And they are also a really, I'd say, a fantastic dividend growth and share repurchase stock, where their dividend yield's only 1.4%, but they consistently raise their dividend payout, and they're consistently repurchasing stock, which I think is down 50% over the long term. Their shares outstanding. So the fact that they consistently repurchase stock for you, they're just consistently returning cash to shareholders, bodes well. And it's a fantastic combination when you have a stock that stays reasonably valued. You have one that has multiple competitive advantages, or at least the underlying company does. And then you have this management team that's consistently growing its dividend. That's a fantastic combination to just sit back and, if you buy at the right price, don't sell.
Yeah. Yeah. I love the call out to all those KPIs because I think that's a great way to look at the company and make sure that the things that you want to see continue to grow are the things that are growing, and to spot any potential problems, because just looking at the revenue numbers or maybe the profitability numbers can be helpful. But I think if you pick out those KPIs, that can be very, very instructive as a way to quickly scan through and say, where problems may be occurring. And I think that's a great way to do it. And I agree with the never sell part of it. And it's a big reason why I bought it for my daughter's, investment account. She was 9 years old, 9 years old. That's why I was buying it then, because I think it's something she can hold on to for the next 20 years and not break a sweat. So I've been sold for a while. So I guess,
I agree.
yeah. All right. So I appreciate you coming again and talking to us about stocks today, and American Express was in the crosshairs. So where can people find more about Brett and what Brett has going on?
Beautiful. Yeah. Chit Chat Stocks podcast. Co-host it with Ryan. I guess he's been on the show before.
Oh yeah,
I
Ryan's
think
been
with me
several
back in the
times.
day. Yeah. So we do stock analysis. We interview people such as Dave or Andrew about stocks, sectors, the market in general. We cover things like super investors, and then we talk through financial news and earnings and just stocks in general. And you can find that on YouTube, Spotify, Apple Podcast, or read our free newsletter on Substack. And thanks again, Dave, for having me on the show.
Yeah, my pleasure. As always, it's a lot of fun to chat with you. No pun intended. And I will say that their show is one of the first things I listen to every time a new episode comes down, because he and Ryan always drop some great nuggets. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.